Most people invest completely wrong. The rich, they play by an entirely different set of rules. And today, I'm gonna break down exactly how the wealthiest investors are positioning their portfolios and how you can do the same. I manage over $1 billion in assets, and I can tell you firsthand, what the average investor does is not going to optimize your wealth building process. Stick with me and I'm gonna show you exactly what the ultra rich are buying and selling right now today. Now, before I tell you exactly how the wealthy, how the ultra rich are investing, I think it's important really just to define wealthy and ultra rich for the purposes of this video. Because look, I mean, some people with $1 million believe that is wealthy. Other people, if they have 3 or 5 million, they believe that's wealthy. That's fine. I'm not disputing that, but what we're talking about for the purposes of this video is wealthy would be somebody with $10+ million, and ultra rich would be somebody with 100 million plus. Now, when we look at the average investor, most average investors take a cookie cutter approach, especially as it relates to asset allocation. If you look at any textbook recommendation on asset allocation, you'll see a lot of people talk about the 60-40 portfolio. In another video, I do explain why this 60-40 asset allocation model isn't right for most people. In fact, personally, I don't think it's right for anyone. So in that other video, I do provide a solution and a strategy that I believe is better. But what I will tell you is the traditional 60-40 portfolio, what a lot of textbooks will recommend is 60% in stocks and 40% in bonds. Now, that is not customized for you as an individual investor or for any individual investor, first of all. Second of all, look, I gotta tell you, I don't care if you are 40 years old, 60 years old, or 80 years old, having 40% of your money in bonds is way too much. As it relates to this cookie cutter 60-40 portfolio, 60% stocks, 40% bonds, people just kind of plug and chug away. You know, they believe that that is the methodology that they should follow. And without questioning whether or not it's right for them, that's what they do. Now, as we look at the 60% of the money that the average investor may have in stocks, they may have it in different types of stocks. U.S. stocks, U.S. large cap stocks, U.S. small cap stocks, emerging market stocks, diversified international stocks. So there's a ton of different categories within stocks. I'm trying to keep this very basic. And then the same thing goes for the 40% that's recommended in bonds as well. That could be treasuries, investment grade corporate bonds, agency bonds. There's a ton of different subcategories underneath bonds as well. Now, the issue is the average investor's over-reliant on this very basic, very vanilla asset allocation strategy. The wealthy, the ultra-rich, they're not doing this. So we need to talk about exactly what they're doing. So the way this works as it relates to asset allocation and where the average investor invests his or her money versus the wealthy investor or the ultra-rich is we are talking about a significant difference in return potential. If you think about that 60-40 portfolio, on average, that's probably going to generate roughly a 6-ish% return. That's what it's done over the course of the last 25 years or so. If we look at the average returns of 6%, if you look at this graph here, starting off with $100,000, over the course of 25 years, if your money grows and compounds at a 6% annualized rate, which is pretty much in line with where you would expect a 60-40 portfolio to actually perform at, your 100 grand grows to a little over $400,000. Not bad. You 4x'd your money, not too shabby. However, when you look at the return potential for the way that wealthy and ultra-rich investors allocate their money, they're expecting returns much, much greater than that 6% return. In fact, on average, their expected return is 10% annualized. And when you start with $100,000 over the course of 25 years at a 10% annualized return, you end up with over $1 million, almost 1.1 million. So you have 10x'd your money over the course of those 25 years. Obviously, the more we're earning on an annualized basis, the more money we're going to have at the end of the day. But you can just see the great disparity that exists between getting a 6% return and a 10% return. So I think it's important to make note of exactly what the traditional investor, the average investor, typically owns in that 60-40 strategy. And it's basic. It is incredibly vanilla. And you know what? Sometimes vanilla is okay. So I don't want to make vanilla sound like there's a negative connotation associated with it, but it's very basic. And so, again, sometimes basic's okay, but what the average investor likes investing in tends to be the S&P 500. So you're investing in what most people consider the stock market. It's the 500 largest publicly traded stocks in the world for the most part. Then bonds. And they're probably just in a bond ETF or maybe a bond mutual fund. It holds a diversified basket of different types of bonds and bond funds. And sometimes just target date funds. You figure out in which year you're planning on retiring, and maybe it's 2040, maybe it's 2045, 2050, whatever your target date is for your retirement. And what happens is as you get closer to that date, the strategy becomes more and more conservative. And you will own less in stocks, more in bonds. And I already told you in this video, I don't like that. I don't like owning any more in bonds than we have to. So that's how the average investor plays the game. But if you want to actually build and compound real generational wealth, you got to do things differently. So let's dive into what the wealthy are doing differently right now. There are three major areas where a wealthy or ultra-rich investor's portfolio is going to differ from that of the average or traditional investor. The first place is that the wealthy and the ultra-rich, believe it or not, hold an increased amount of cash reserves. Now that sounds counterintuitive because I've already said that the rich and the ultra-wealthy generate higher total returns. So you might be wondering, how is it possible to generate higher total returns if I have more money in cash earning lower returns? Wealthy and ultra-rich investors, yes, they have an increased amount of cash reserves, but how much are they holding in cash reserves? On average, 20 to 30%. It's a big number. Now, look, if you are at the $1 million level or the $5 million level, I think 20 to 30% might be a little too much. But if we're talking about people with 10 million, 50 million, 100 million, there is a specific reason why they hold 20 to 30% of their portfolio in cash reserves. If you think about one of the world's greatest investors, Warren Buffett, with a net worth of well over $100 billion, his company, Berkshire Hathaway, right now is sitting on $334 billion in cash as of the beginning of 2025. That is a lot of money to be holding in cash. So you might be wondering, why would a wealthy or an ultra-rich investor want to hold so much in cash? Warren Buffett is famous for several sayings. I mean, he's like the common man who just happens to be incredibly wealthy. And he's done a great job over the course of his long career in making smart financial decisions. But one of the things he's famous for saying is you should be fearful when others are greedy, and you should be greedy when others are fearful. Now, I love that saying, because that will directly show you one of probably the greatest reasons why Warren Buffett, Berkshire Hathaway, and other wealthy investors hold money in cash, especially in today's economic and stock market environment. The reason they hold so much in cash is because they want to be opportunistic when an opportunity presents itself. They want to have the ability to buy assets when they're on sale. They want to have the ability to buy assets when they are distressed. And when I speak of assets, Yes, I could be talking about specific stocks, whether it's Nvidia or Apple. If those are on sale, you might want to load up on them. For the rich, the ultra or the wealthy, the ultra rich, I mean, this could be an apartment building that they want to buy. It could be a vacation property. It could be a private equity opportunity. There are lots of different opportunities as it relates to investments that you could participate in at reduced levels. Now, the second place where the wealthy and the ultra rich differ from the traditional investor is they hold a lot of alternative assets. Typically 30 to 40% of their portfolio is in alternative assets. If you think about Harvard's endowment fund, particularly, that has over 50% in alternative assets. So you might be asking yourself, well, Mark, what the heck are alternative assets? Alternative assets are those things that are different from your typical stocks, bonds, publicly traded securities that you may hold in your portfolio. Alternative assets, one of the greatest benefits of them, well, there's several benefits. Number one, they typically enhance your returns. So typically, over a 5, 10, 20-year time horizon, they should help you to generate greater performance in your portfolio, and they do so with less volatility, which is super cool. Now, the issue with alternative assets is that they are liquidity constrained. What I mean by that is that if you put X amount of dollars, let's say $100,000 into an alternative investment, an alternative asset, and you wanted your $100,000 back tomorrow, you're probably not getting it back tomorrow. Typically, they may only give you the ability to have a redemption and withdraw some of your money, possibly on a quarterly basis, as an example. And if you want all of your money back when times are good at the end of a quarter, you're probably going to get it back. However, if you want your whole $100,000 back when times are bad, my guess is everybody else wants theirs back as well, and you're not going to get it all back. So it's something to understand. You have to size this asset class appropriately because there is a liquidity issue. Now, let me give you some examples of alternative assets or alternative investments. The first is real estate. So there's certainly some very, very excellent opportunities available as it relates to investing in private real estate. There are private real estate opportunities that may invest in casinos in Las Vegas, maybe data centers that are necessary for artificial intelligence, maybe warehouses that are necessary for e-commerce. So there's a lot of great opportunities out there from a private real estate alternative investment opportunity. Beyond that, another area we may look could be private equity, and that is where you own privately held businesses that are not publicly traded. Great opportunities to hold very, very solid companies at attractive valuations that typically grow a heck of a lot faster than the public markets over time. Another area could be crypto. A lot of people have been interested in Bitcoin and Ethereum and all the different crypto coins that are out there, and they always wonder, does this fit in my retirement portfolio? And I can tell you it does within that alternative asset sleeve. And in another video, I tell you exactly how to appropriately size that crypto sleeve in your portfolio. And another option could be investing in hard assets like gold, silver, copper, oil, anything like that that could be considered alternative. Hey, if you're liking this so far, if you think you're getting good content, good information, make sure you like this video, make sure you subscribe to our channel, and make sure you hit the little bell there so that you can be alerted every time we come out with new, fresh content. And the third difference is the wealthy and the ultra-rich investors love dividend stocks and cash flow. And you might be sitting there thinking, wow, dividend stocks sounds kind of boring, not that sexy, not that interesting. But I'll tell you what, they make people money. And that is why the wealthy and the ultra-rich have accumulated such vast amounts of wealth. If you think about it, some of the greatest dividend investors ever, Warren Buffett is one that comes to mind. Yes, he's technically a value investor, but if you look at the portfolio of stocks that he owns, just about every single one of them pays a dividend. And the great thing about dividend paying stocks is if you are unprofitable, you cannot pay a dividend. So every single company that's paying a dividend right out of the gates, you know they're profitable. And they are confident that they are going to maintain profitability. If they weren't confident, they wouldn't be paying a dividend, because cutting your dividend is a death blow for many stocks. Another famous dividend investor is Mr. Wonderful, Kevin O'Leary from Shark Tank. His estimated net worth is around $400 million, and he has said that he would never own a stock that doesn't pay a dividend. According to Mr. Wonderful, over the course of the last 40 years, 71% of the stock market's returns came from dividends, not capital appreciation. Beyond that, one of the things that I really like about dividend-paying stocks is that historically, if you go all the way back to, I don't care if you start in 1929 or 1950, historically, dividend-paying stocks have outperformed non-dividend paying stocks, and they've done so with 30% less volatility, which certainly becomes incredibly important as you get closer to retirement and during retirement, because taking money out of your portfolio while stocks are depressed, in the middle of a correction, in the middle of a bear market, is one of the worst things you can do to your overall retirement plan. All right, quick time out. Before we move on, I need to know in the comments, are you holding higher cash reserves right now today? Do you own dividend-paying stocks? Do you own any alternative investments? Let me know in the comments. Here's what you should be doing right now, given everything we've talked about. The first thing you should do is reassess your cash reserves. Are you holding enough in cash right now? Now, look, again, the wealthy, the ultra-rich are holding 20 to 30% in cash. If you don't fit in one of those categories, that might be a little too high. But should you increase your cash reserves to possibly 10%, 12%, 15%, so that if there is a correction, if there is a bear market, if there is a real estate correction, if anything happens where assets end up on sale, you want to have the cash available so that you can buy them when they are lower. Like every great investor knows, you don't make money by buying high and selling low. You make money buying low and selling high, but the only way you can buy low is if you have the cash available to do it. Now look, when I say cash reserves, I don't want you holding the money under the mattress. There are high yield savings accounts that are out there right now that are paying 3.5%, 4.5%. So look around, do your research, and make sure you're getting at least 3 to 4% on those cash reserves while you're sitting around waiting for an opportunity to present itself. The second thing you should be doing is you should consider adding alternative assets. What is the right percentage for somebody who may not be considered wealthy or ultra rich? I would suggest you consider at least 10% of your portfolio in alternative assets. And I would likely split that amongst 3 different individual investment opportunities. So maybe 3-ish% into each of those. I would be considering private real estate. So you figure out what kind of real estate you want to own. Again, maybe it's data centers, maybe it's casinos in Las Vegas, whatever floats your boat, you can allocate some money there. Another great category, private equity, where you're investing in privately held businesses. There's a crypto opportunity here. And I got to tell you, one of the coolest investment opportunities we've brought to our clients over the course of the last few years has been the opportunity to invest in professional sports franchises. Super cool, especially if you are a sports fanatic. The ability to own a sliver of teams like the Buffalo Bills or the Golden State Warriors, Chicago Cubs, Tampa Bay Lightning. Not only is it super cool, but the valuation of professional sports franchises over the last 20 plus years has exceeded the returns of the broader stock market, without experiencing those nasty drawdowns that most of us saw during the Great Recession and during the COVID lockdowns. And the third thing you should be doing right now is you need to build a cash flow-based portfolio. How do you do that? You need to start looking at dividend-paying stocks. Here's an example of a dividend growth stock, a stock that has been consistently raising its dividend over the course of the last 10, 20, 30 years. AbbVie, a healthcare company, if you look at the dividend that it was paying back in 2013, it was a little more than $1.50. Fast forward to 2025, that dividend is now $6.50. That is incredible growth in the value of the dividend that's being paid out to investors. Now the question becomes, should you just identify those particular stocks that pay high dividend yields? And my personal take on that is no. I want to look at a hybrid approach whereby there's going to be the opportunity for capital appreciation. The stock goes from $10 a share to $20 a share, combined with dividends. So in order for me to find that, I want to look for companies with great fundamentals. I want to identify companies whereby I believe that they have the opportunity and the ability to grow their earnings, not just their dividends, but to grow their earnings at a rate that exceeds that of the S&P 500. Once I can identify those companies, then I want to make sure they pay a dividend as well. The bottom line, the rich don't play the same game. They don't buy into the hype. They want to make sure they've got cash available so they can invest in opportunities as they present themselves. They own smart alternative investments, and they own dividend-paying stocks that give them the ability to outperform over a longer time frame with less volatility. If you want to see exactly how the wealthy invest and protect their wealth, make sure you hit that subscribe button right now, like this video. Every single week, I'm breaking down market trends and portfolio strategies that you're not going to hear anywhere else. So make sure you like the video, make sure you subscribe, make sure you hit the bell, and you'll know exactly when our latest video comes out. Furthermore, make sure you comment below. What is your investment strategy right now? I'd love to see it. I'd love to give you some feedback. In the meantime, you can also follow me on X at Mark Tepper SWP. See you soon.